A drawdown in trading or investing refers to the decline in your account value from its highest point, known as the peak, to its lowest point, known as the trough, before recovering to that previous peak. Think of it as the financial equivalent of climbing a mountain, then slipping down a certain distance before you can climb back up. This measurement is critical because it captures the real-world volatility and risk you are exposed to. The most important rule about drawdowns is their asymmetric mathematics. A 10% loss requires an 11% gain to break even. A 20% loss requires a 25% gain. A 33% loss requires a 50% gain. And a 50% loss requires a full 100% gain. This means that the deeper the hole, the exponentially harder it is to dig yourself out. Why is this so dangerous? Because while the market can drop quickly, it often recovers slowly. A sharp drawdown can erase months or even years of careful gains in just a few days. The psychological impact is just as severe. Watching your account shrink often leads to fear-based decisions, such as panic selling near the bottom, or taking unnecessary risks to try and recover losses. The key to protecting your portfolio is simple but difficult in practice: keep your drawdowns small. Professional traders often risk no more than 1 to 2% of their capital on any single trade. They know that preserving capital is the first priority. If you can survive the inevitable losing streaks without severe damage to your portfolio, you stay in the game. Avoiding large drawdowns is not about avoiding risk entirely, it is about managing risk smartly. This involves using stop-loss orders to exit a position before a small loss becomes a catastrophic one. It also means diversifying your trades or investments so that a single bad event cannot wipe you out. Position sizing is another critical tool. Never bet so big that a normal market fluctuation causes you significant pain. Some of the greatest investors in history have endured massive drawdowns, but the ones who survived and thrived were those who limited their exposure before the worst of the damage occurred. They understood that markets can remain irrational longer than you can remain solvent. A small drawdown is a manageable setback. A large drawdown can end your career. Therefore, your mental approach should be to treat every loss as a lesson in humility and risk management. If you accept that losses are a normal part of investing and trading, you can plan for them. The goal is not to win every time, but to ensure that when you lose small, and when you win big enough to overcome those small losses. In summary, drawdown is the single most important metric for long-term survival. A 20% drawdown needs a full 25% gain just to get back to even. Protect your capital fiercely, keep your losses small, and let time work in your favor. Master this concept, and you transform from a gambler into a disciplined investor.